Hey folks, this is Jeremy North, Chief Investment Officer from 360 IRA with your educational economic update for September 2020. Well, I hope this video finds you very safe and healthy during these times. Well, in this month's video, I'll discuss major headlines that influence markets in August. I'll also provide insight into what these developments could mean for you going forward. Also, as always, please stay tuned for the end of this video with a very exciting required disclosure statement. Well, the stock market's performed very well, as this was the best August since 1986. The problem is that the economy is not doing so well, and not all stocks are doing well. In fact, only a handful of the biggest companies continue to lead the market. The stocks that have been performing the best and leading the indexes higher is like Amazon, Facebook, Google, Microsoft, Netflix, because they've not been hurt by economic conditions and have most typically actually benefited from them. But as you know, earlier this year, the global economy experienced its largest and quickest contraction since the Great Depression due to COVID-19. With many economies partially opened back up, data suggests that the initial stages of economic recovery across the world happened at a faster pace than anticipated. However, as second waves of COVID-19 hit, the pace of recovery has slowed due to a resurgence of lockdowns, especially in many regions across the US. After sinking sharply in July to 97.1, August's consumer confidence reading declined further and fell far short of expectations with a reading of 84.8. So let's go through August's performance and then discuss the reasons for the separation between the economy and the stock market and what we can expect going forward. Well, the Dow Jones Industrial rose about 7.6, the S&P 7, and the NASDAQ composite tacked on another 9.6%. The aggregate bond index was down about 0.82%, while the high yield bonds were up about 1% for the month. The incredible advance of the stock market, while the coronavirus pandemic has drastically dampened the US economy, has been confusing, to say the least. The market's lost 30% or more from the end of February to the end of March, but since then it's come back 60% plus, while the US economy shrank about 32% in between April and June quarter. In a recent article by Wharton, they have identified three factors that could explain the apparent disconnect between the stock market and the economy. First, the stock market is meant to be forward-looking, and in general, what we see right now in the economy is what's going on right now in the economy. This means the market is pricing things that may happen in the future, such as a vaccine and reopening of the economy. Secondly, the Federal Reserve, by lowering interest rates and keeping them low, has injected a lot of money into the market, and that certainly helps keep stock prices up. The Fed not only has continued to keep interest rates at historically low levels, it is also buying up Treasury, mortgage-backed securities, and for the first time, corporate bonds. And third, as stated earlier, the mega tech stocks that have been benefited greatly in market price have pulled up the entire stock market. These companies do not contribute the same level to the economy as they do to the market. In fact, the rise in sales from firms like Amazon have led to many small businesses closing down for good. Many millions of Americans are out of work, and until COVID-19 is under control, their jobs may not come back. The current frenzy in the market will not last forever, especially if an economic revival does not happen soon. Remember, the markets are forward-looking. If signs of an economic recovery do not come to fruition or appear premature, we could see a correction or worse, a bear market. While the market indexes are generally reaching record high levels, the concern is that with the economic hardships caused by the virus and the lockdown across the world, the markets are at levels that definitely require caution. Investors would be wise to have a plan. At 360 IRA, we are aware of the risk and often suggest lower volatility strategies as well as higher yielding investments that can provide capital preservation and hopefully more peace of mind. We take a big picture approach so that your retirement goes as smoothly as possible from an economic viewpoint. As we look ahead, we will continue to examine how economic trends, COVID-19, and of course the upcoming election may affect each client's financial life. If you have questions about how the recent economic report could impact your long-term goals, I am here to talk. We are here to talk. Once again, this is Jeremy North with 360 IRA signing off for the month of September 2020. Please remember that nothing we talk about here is a direct recommendation. If you would like to discuss your personal financial situation or portfolio, please give us or me a call at 636-896-4052. We are happy to talk. With all that being said, here is the super exciting disclosure that I am required to read. While we believe the information is in the report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as an investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining markets. The indices mentioned are unmanaged and cannot be invested into directly. Past performance does not guarantee future results. Thanks again. This is Jeremy North, September 2020. Take care, everyone. Stay safe.